So I was talking about what we did last week, and we looked at the changes in exchange rate, which is LKS 21. So the changes in foreign exchange rate, the effects of changes in foreign exchange rates most likely might not come as a separate question, but it could be part of an MCQ, or it could be part of a question number 1 adjustment. So there had been one question of this kind in past papers. We will come across that, but more or less, I would suggest that it may not be in the form of a fully fledged question which is for 20 marks. So basically, it will be a smaller part out of your entire syllabus. Then we also looked at LKS 8, which talks about the accounting policies and changes in accounting estimates. So what I was explaining is, when you look at the changes in accounting policies, the changes of accounting policies will have a direct impact to your financial statements. And those changes will have to be incorporated into the financial statement. And it has to be mentioned in your notes to the financial statements saying that the change has taken place in the accounting policies. Similarly, there could be a situation where you will change the accounting estimate. For example, if we take computer equipment. Now, with your prior experience, you would have decided to depreciate computer equipment for 5 years. That is for 20%. But in the recent past, you would have observed that these computer items are getting either dilapidated, or maybe say frequently you are having issues which have to be replaced. So you might go for an alternative time period of say 4 years or 3 years. So then you will go and change your accounting estimate from 5 years to 4 years or 3 years. Now this change is going to take place in 2020, let's assume. But the impact of these changes in estimates will have to be brought in retrospectively. What do you mean by retrospectively? Say, for example, you have purchased an computer equipment 2 years before. So which means you have now depreciated only for 2 years, which was originally estimated to be depreciated for 5 years, which means there are 3 more years to go. But suppose if you go and change this accounting estimate in the current year, then what will happen? The remaining time period comes short. But the impact of same will have to be calculated retrospectively. That is, from the date you purchase the asset. So as a result, there will be an increase in depreciation in the current financial year. But the company has to bear it. That is what accounting standards say. Okay. So accounting policy is also an important part of financial statements. I don't think that you will get questions in detail to write about accounting policies, but more or less there might be questions asking what is an accounting policy, what are the basic principles that you need to follow, and also the impact of changing an accounting estimate. Okay, so those type of questions might come. Then finally we looked at inventories, which is LKS 02. So LKS 2 talks about stocks, or in other words, it is the inventory. So we looked at what is covered under LKS 2 and what is not covered under LKS 2. So as far as the definitions are concerned, we went through the definitions and we identified what are the 3 forms of inventories. A company can have the 3 forms of inventories or stocks. So namely, the inventories can have 3 levels: trading stocks, work in progress, or raw material. So trading stocks means what you have displayed in your showroom or in the shop, which is ready for sale. Work in progress is something where you are still working on the product, or it is being processed, and it might take some more time for you to bring it to the Sure. Raw material is very beginning stage of the production where you have just purchased your raw materials, but those are supposed to be converted into finished products or trading stocks. So when it comes to accounting, we consider all these three under inventories. So as far as the two other types are concerned, that is work in progress and raw materials, are more or less applicable to manufacturing organizations because they only purchase raw materials, process them, and there can be a situation where it could be in transit, and then only you will convert it to the final product. And inventories, it is important for a company to do a valuation at the year end. So the valuation techniques, either it could be at fair value or at the net realizable value. But as far as the accounting standard is concerned, we consider the lower of these two amounts. Okay. Why it is considered to be lower? Because when you take a higher value, by that you are going to overstate your stock value. So when you overstate your stock value means your balance sheet will get enhanced, which is not advisable. So as a result, the understandable best practice is to consider the lower of either it could be cost or it could be the net realizable value. Then we also looked at two important methodologies that are used to value the stocks. One is the first in, first out. I explain what it is. And then the weighted average cost method. And apart from these, we can use LIFO, which is last in, first out. And also there are similar methodologies which are used for stock valuation. So with that, we had a question. This is what it is. So I hope some of you might have attempted this question, but let's try to do it on the board so that you will get an idea about how this type of a question can be handled in the examination. Okay. So basically, if you look at this question, there had been 3 times where the company has purchased stocks or goods, and there had been 3 instances where they have made a sale also. Okay. So the question here is, what is the objective? Our objective here is to identify or find out what is our remaining stock value. We are not concerned about how much of a profit the company has made or maybe at what price they have sold it. Those are not concerns. Our concern is we have purchased goods at 3 different rates, different units at different prices, and we have sold also. So after doing all those, what is our remaining stock quantity as well as the value in terms of rupees or whatever. Okay. So the sequence of events is very important in this type of a question. Okay. That is the dates, the order in which the transactions have taken place, because depending on that, the answers might differ. So in this question, where they have requested you to do both on FIFO as well as weighted average cost method. So we start off with the FIFO method, that is very straightforward, and we see how this works on computing the closing stock value. Okay. Okay. So I hope now you can see the board. So if you look at it, we will be using a template similar to this, right? So first we will calculate using the FIFO method. So we will have the date, quantity purchased or sold. We are going to have both, right? Then price per unit, then value, and finally the running balance. Okay, so this is how the template would look like. So we start off with the first transaction, which is a purchase. They have purchased on 10/5/2019. So there is no opening stock here. If not, we would have brought in the opening stock just to show there had been a value. So here we are doing a purchase straight away. Firstly, on 10/5/2019. 10/5/2019. And they have purchased 1,500 units. 1,500 units at 5 rupees per unit. 5 rupees per unit. So which means 1,500 units at 5 rupees means it is 7,500 in value. 7,500 in value. Okay. So this 7,500 will be your starting balance. Starting balance. So now you have to go through the list and find out what is the next date of the transaction. So after 10th May, there had been a purchase of 1,750 units on 18th June. 18th June. But before that, that is 11th of June, there had been an issue of 1,200 units. So which means they have sold 1,200 units. So on 11th June, they have sold 1,200. Now, when you come to this point, it is only this amount of units that you have in this calculation. So we are going to remove 1,200 from there. Now this 1,200, in the question also there is no mention about at what price they have sold it, which is not relevant to us. But if you look at the number of units that they have sold or issued is 1200. So 1200 is going to be removed, and again this will be at the same price because we are using FIFO method. What came in first have to go out first. That is what FIFO means. FIFO means what has come in first, what has to go out first. So first in, first out. So 1200 units into 5, which gives you 6000. Now this 6000 is going to get reduced from your overall balance. So which means 7500 minus 6000, which will give you 1500. So the closing stock value, if we are asked with the question of what is the closing stock value on 11th of June, means it is 1500 rupees. Now you might be wondering how this 1500 value came. So basically 1500 is 1005 minus 1002, which is 300 units. The 300 units into 5 rupees is the 1005. Okay, so you have to be, what I'm going to write here is not relevant, but don't write it in the exam. But actually this is 300 units at rupees 5. Okay, just for your reference. Right. Now what is the next transaction? The next transaction is where they have again purchased goods on 18 June for 1750 units at rupees 8 each. 18 June, 1750 units at 8 rupees each. 1750 units at 8 rupees each. So what is the value there? It is 14,000. The value of the stock that has been purchased is 14,000. Just check the calculation. It will be 14,000. So this 14,000 plus 1,005 becomes 15,500. 15,500. So the closing balance as of 18 June will be 15,500. 15,500. So what is the next transaction now? What is the next transaction? The next transaction is where they have issued 1,250 units on 2nd of July. Here comes the problem. They have issued 1,250 units. Don't write. We are just trying to analyze how this is going to happen. Now the 1,250 can be issued in many ways. How? Straight away you can take from this and issue the 1,250 units. Or you can take the cumulative balance, that is 300 plus 1,750 is 2,050. From that also you can issue. But the problem is you don't have the price. This is where the problem comes. Now we have to make a call on this FIFO method. So what do you mean by that? I have to issue this 1,250, taking into consideration what came in first has to go out first. So what came in first is this 1,500 units at 5 rupees each. Then what happened? I issued 1,200. As a result, I have 300 remaining here. So what I will do is, on 2nd of July 2019, I am going to issue 300 units from 5 rupees. 300 units from 5 rupees, which amounts to 1,500. 1,500. So, but my requirement is to issue 1,250. 1,250. So 1,250 means I have issued only 300 from here. I have issued only 300 from here. So I have to issue another 950. But that 950 is going to go out from this 8 rupees. From this 8 rupees. So 950 into 8. 950 into 8. So this is now 7,600. Just do the calculation. 7,600. So now what is going to happen? From the closing balance, 15,500 minus 1,500 means 14,000. Now 14,000 minus 7,600 means 6,400. 6,400. Now the question here is, what is this 6,400 is? Can somebody answer what is this 6,400 is? Any idea what this 6,400 is? So the 6,400 is actually, if you look at it, this 1,005 minus 1,002 and this 300. So which means all these get cancelled. Then this 1,750 minus 950, which means there is 800 units. So 800 units into 8 rupees is the 6,400. 800 units into 8 rupees will give you 6,400. Yes, one person has answered it, very correct. 800 units at 8 rupees will give you 6,400. Now you see, in this question, the remaining two transactions, a purchase and a sale, is going into the 2020. 2020. So suppose if this is a question where the company is a 31st December company and they want to find out what is the closing stock value as of 31st December, which means it has to be 6,400. Okay. So sometimes those type of confusing questions also might come. They will give you transactions pertaining to 2 years, which are crossing 2 years, but they might restrict the question asking you to calculate the value for the closing year. So if you consider for 31st December, then you are not required to consider the two transactions of 2020. But suppose if they say the company's financial year closes on 31st March, then you have to consider the balance two transactions also. Okay, but now since we are doing this as a practice question, so we'll look at the next part, that is on 12th February 2020, where they have purchased 2,500 units at the rupees of 7. So which means this is 17,500. 17,500. 500. So 17,500 plus 6,400 means 23,900. 23,900. And the last issue is 18 February. And where they have issued 1,900. Against there is a problem of issuing 1,900. So 1,900 means now the initially purchased stock is no more because we have already sold. This 1,750 minus 950 gives us a remaining balance of 800 units. So now we are required to issue 1,900, which means first I have to issue the 800 units. So I will issue the 800 units at the rate of 8 rupees. That will give me 6,400. If that goes out, my closing stock will be 17,500. So now my requirement is 1,900. As a result, I will issue another 1,100 units. And that will be at 7 rupees. So that will be 7,700. And now I am required to deduct 17,500 minus 7,700 means 800, 1,500, 9,800. 9,800. So again the question is, what is this 9,800 is? 9,800 is, if you just simply look at it, this will have an answer of 1,004. 1,004 means the remaining from this, and that will be at 7 rupees. That will give you 9,800. Okay. So this is how you do it in FIFO method. FIFO method. If you have any questions, please ask. Okay. So now let's look at the average cost method, use of the average cost method. Okay. So average cost method is where you will have to calculate the average price to do the valuation. Okay. So the only change that is going to happen here is the first transaction will go through, that is 1,500 units at 5 rupees each, 7,500. So you will get 7,500. Now, before you do the next transaction, that is when you are issuing goods from your stocks. So when you are issuing goods from your stocks, unlike in the FIFO method, here I will have to calculate an average price for the transfer. Average price for the transfer. So how do I calculate the average price? Average price is basically your running balance divided by the quantity on hand. Running balance divided by quantity on hand. That is how we calculate the weighted average price. Weighted average price. So every transfer, that is when you are issuing goods outside, those have to be issued at an average price. Now here what did we do in under FIFO method? Whatever the price that you have purchased, we have dispatched it on the same price. Okay? But here it is not the case. Every time when you are issuing goods, you have to calculate an average price. So in the first scenario, 1,500, you will issue, you have got 7,500. So average price for this will be 7,900, 1,005 is 5 rupees. Then you issue the 1,200 units, it is 6,000, now it is 1,500, 1,500. So now, let me erase this. Right. So before I go into the next transaction, what is happening now? On 10th of May, I have purchased, 11th of June, I have issued. Now what happens? On 18th of June, I am purchasing another 1,750 units. So 18th of June, 2019, 1,750 units at 8 rupees. This is 14,000. So that will give you 15,000. Okay, 15,500. Now, what is the next transaction? It is on the 2nd of July where you are issuing 1,250. Now, before you get into this level, you have to do a small calculation. You have to do a small calculation. What is that? That is, now you have to look at what is your closing stock. So 1,005 minus 1,002 means 300. 300 plus 1,750 means you have 2,000. 2,050. Now what do you mean by this? Under the weighted average cost method, you have 2,050 units at a value of 15,500. 15,500. So what you have to do is, you have to calculate the price, weighted average price, before you get into the issuance of next item. So what do we need to do here? We have to calculate the average price. Average price. So what do we do here? 15,500 divided by 2,050. Now comes the problem. You will have a price something like this, which is coming with decimals, where you have to consider it for 2 decimals. You see? Now how do I get this 7.56? That is basically 15,500 divided by 2,000. 15,500 divided by 2,050. So you will get 7.56. 7.56. Okay. This is how it happens in exams also. You will get the same thing. Somewhat similar to this. Okay. So now, going by the question, on 2nd of July, I need to issue 1,250. On 2nd of July, 2019, I have to issue 1,250. And that will be at this average price. Average price. Okay. So now 1,250 into 7.56. What is the value? That gives you 9,450. 9,450. Which means you come up to 6,000. You see, there is a clear difference between the FIFO method and the weighted average cost method. So what is the difference that is coming up is, before, in the method of weighted average cost method, before issuance of goods, you have to calculate an average price. So at which price you are going to issue it. Earlier you used the first in first out. Similarly, you might have to use last in first out also if the method is LIFO. But weighted average means you have to calculate it based on what is the average price. Okay. So now next part is the receipt of 2,500 units. So that is on 12th February. 2,500 units at the rate of 7. Okay. So which means 17,500. Okay. So which means 23,550. 23,550. Now we have the same issue again. Before we issue the next set of goods. Okay. We have to calculate the remaining stock as well as so you will have 3,300. And what will be your price? What will be your price? 23,550 divided by 3,300. So that comes to 7.14. 7.14. Again, it's the average price. The average price. So now we have to check 7,500. Sorry. What is the number of units that you are going to issue? 1,900 units. 1,900 units at the rate of 7.14. So that comes up to 13,566. 13,566. So your closing stock value will be 998. This is on 18th February. Okay. So this is how you do the stock valuation when it comes to using the weighted average cost method. Weighted average cost method. So you can ask any question you have. So in the previous valuation technique, what was the closing value? Closing stock value. That was 9,800, I think, which is 1,400 units. 1,400 units at the rate of 7 rupees. So yes, 9,800 rupees. But when you use the average cost method, you will see it is 9,984. Okay. So when there is big price variations, then the weighted average cost method will have a higher value as the closing stocks. Okay. Weighted average cost method will have a average, higher value in terms of stock valuation. Right? Do you have any questions? Right. Now have a look at this question and see whether you can do it. This is a question which came in March 2019 as an MCQ. This is an MCQ for 2 marks. Okay, so see whether you can do this. So if you look at this question, they say Melody Trading Limited sells DVD players to its customers. As at 1/1/2018, it had 40 units of DVD players. So now here what happens, this company is starting with the opening balance, because this is a business that had been continuing. So they have a opening balance now. Now in the earlier question that we did, we didn't have an opening balance. So we started fresh. But here they have an opening balance. So the opening balance is 40 units of DVD players purchased for rupees 4,000 each. 4,000 each. It sells each unit of DVD player for rupees 7,000. That is their selling price. In the year 2018, it had total sales amounting to rupees 1.4 million. Purchases during the year are as below. So they are giving you some dates for which how they have purchased these units. Using the following two methods, calculate the cost of closing inventory of Melody Trading Limited as at 31/12/2018. As at 31/12/2018. So you have to be very careful, because this question is an MCQ. So roughly, if you look at an MCQ for 2 marks, means you can spend about I think altogether 36 minutes you can spend, and in that 36 minutes, for this you can spend at least 1.8 minutes, I think. Yeah. Yes. So you have to be very careful in doing it quickly. Okay. So what I'm going to do is I'm going to leave it with you all for you to give an attempt. Those who are having novel answer books or whatever, don't refer to the answers, but give it a try to do it in your own using the two methods. And you have to be mindful that this is a MCQ question. MCQ question. Okay. Right. So with that, we conclude that topic, that is on the other standard, miscellaneous standards. Now today I'm going to start with a new topic, which is the topic on regulations to banks, right? So what I would say here is the regulations to banks section is one separate question that you get. Okay. So there will be one particular question where you will have this area, that is the regulations to banks. It's a mix of areas, and it will be for 20 marks, where you will have 4 parts. The 4 parts will be having from various sections. So it is very important that you do a lot of reading, because it is not only what we do here. I have compiled certain components of the syllabus or the regulations that have come through, but there are more and enough areas that can be tested. So you have to be focused on what is happening around in the economic world, because this question could be tested on those areas as well. Now what we are going to discuss is whatever the possible technical areas. Okay, but in practice the question may be little variant, where you will have questions coming from some other current scenarios also. Okay, and more importantly, most of the things that we are going to look at will be more of a theoretical. So it could be good that if you can memorize these, because sometimes what happens, these can come for you to write in essay type. So the 4 parts where each will carry 5 marks. So you have to write. So for you to write, you have to know the content. Sometimes certain areas will come in the form of MCQs. So for whatever it is, you need to know this theory background. Okay, right. So let's start now. Right, regulations to banks. So we are starting with the Banking Act direction. As I mentioned earlier, we are governed by the Banking Act direction number 30 of 1988. In that, one particular section, which is on section 20 and 1, subsection 1, which talks about the statutory reserve fund. Now, the statutory reserve fund is a specific fund which is applicable for banks. So what does it say? Every licensed commercial bank shall maintain a reserve fund and shall, out of the net profits after the payment of tax each year, before any dividend is declared or any profits are transferred to the head office or elsewhere, transfer to such reserve fund. Now they are trying to explain here where every bank should have a fund called statutory reserve fund. Now this statutory reserve fund should be built up based on your profit after tax. Now say your bank earns a profit and this profit is calculated after tax. Before you declare any dividends. So before you declare any dividends, they want you to maintain a reserve, which is statutory reserve fund called, and you have to maintain a certain amount. Okay. Now let me explain this on the board because you have to clearly understand this. Okay. So we have a capital and we also have profit after tax. Okay. So what do they say? Right. Right. So I hope you can see the board now. Right. Now what do they say? You have a stated capital which is known as the share capital of the bank, and now they are talking about a profit after tax, and they are also talking about a statutory reserve fund. Okay. Now what do they say? Stated capital is where you have issued shares for the public to purchase or invest, and you build up that money as your part of capital. Okay. So let's say your stated capital is 100 billion. I'm just taking an example. Your stated capital is 100 billion. Now the objective of statutory reserve fund is where you have to build up a statutory reserve fund by transferring from your profit after tax a certain amount so that it becomes equal to this. Equal to. Why you build up the statutory reserve fund is like banks are highly regulated and those are exposed to large amount of risks. Okay. So as a result, as a safety cushion, the banks are required to build up this statutory reserve fund. What is the amount that you need to build up? It is an amount equivalent to your stated capital. So this also keep on changing. Accordingly, that also needs to change. So the stated capital is not fixed. Now I am taking an example of 100 billion, but this keeps on changing. Similarly, when this changes, you have to build up this also so that this becomes equal to this. Now, according to the Banking Act direction, section 20.1, it says you can build up this fund gradually. Not that immediately you take 100 billion and go and put it there, because for you to do that, you have to have that amount of profit. No, you are not supposed to do that, and you are not required to do that also. So the requirement is you can build up this statutory reserve fund over a period. So as long as the bank is there, you can gradually build up this fund so that it reaches at some day which is equivalent to your stated capital or share capital. So how do they want them to do? Step 1 is where every year from your profit after tax, you transfer 5% of your profit after tax. Say if you have earned 10 billion, of that you transfer 5% to the statutory reserve fund until the SRF is equivalent to 50% of stated capital. Okay, I'll use short form so that it will be easy. Where SRF is equal to 50% of the stated capital. So which means up until it becomes 50 billion, you have to transfer every year from your profit after tax 5%. Okay, that is the first thing that you have to do. Once you have reached this 50 billion, then the Banking Act gives you another option. You can build up the balance 50%. Okay, so that is SRF is 100% of stated capital. For that, what you need to do is you can transfer 2% of your profit after tax every year. This is 5% per annum. This is 2% per annum. So every year you will start transferring 2% from your profits every year so that this becomes 100 billion. So step 1 is 50 billion, step 2 is where you reach 100 billion. And the banks have to keep on doing this because as long as this is going to change, you have to keep on doing this. This is called a statutory requirement. Okay. So if you can take down what is there on the board quickly. So now we have to see what is the relevance to us for exams. What is the relevance to our exam? Now this, I haven't seen this being tested in the essay type questions, that is for where you get 20 marks questions. I don't think that they have tested, but this is part of your question number 1. Question number 1, there where you will get some adjustments to be incorporated. Okay, accounting adjustments. Under the adjustments, you have to, some of the times you have to do this. Okay. What happens? They will specify a certain amount where you will have to transfer from the profit after tax to the statutory reserve. So, when you are preparing the statement of changes in equity under question number 1, you have to show this amount. From your profits, you are transferring an amount to the statutory reserve fund. So you will understand this when we are doing the question number 1, how this gets effect, how this is shown in the financial statements. Okay, how this is shown in the financial statement. So I want you to make a note here. Okay, take down. The statutory reserve fund, the statutory reserve fund is a reserve that is reported as part of equity of a bank, hence it becomes a statutory requirement. Hence it becomes a statutory requirement for all the licensed commercial banks. Becomes a statutory requirement for all the licensed commercial banks. So how this applies to our questions, let's look at it when we do the question number 1. Okay. Then section 20.2, what does it say is, the reserve fund of any licensed commercial bank shall not be reduced nor impaired. Now what they do say is, this statutory reserve fund that you are building up should not be reduced at any point in time without the approval of Central Bank of Sri Lanka. Okay, so it is very important to note. Now, when you are building up this reserve fund, you can't just go and reduce it. If you are planning to reduce it due to some reason or to cover up some losses or whatever, you need to go back to the central bank and get their approval to do or reduce the reserve fund. So that is covered under section 20.2. Then we come on to the most important: preparation, presentation, publication, and auditing of financial statement. So now we are trying to understand what the banks do. The banks are required to prepare financial statements, and they need to present them, and also they need to do a publication. Publication means they have to put it in the newspapers, they have to put it on the website of the bank. There are various ways and means of where they have to present their financial statements to the public. Okay, and also these financial statements are generally have to be audited once a year. So your financial statements are actually audited at the year end, and then only it goes into the public hands. But in between, you can publish unaudited financial statements. Okay, right. The statutes governing the preparation and auditing of financial statements of banking institutions are as follows. What are the statutes? Statutes mean the law that governs the preparation and auditing of financial statements. So as I mentioned, Banking Act number 30 of 1988 gives you a lot of directions on this. And it is a huge book if you really look at it. But we can't be learning all the entire thing in this course or the syllabus. So what we are looking at is the most important ones only. Then similarly, the Companies Act number 7 of 2007. That is also another statute which governs the banks. Then most importantly, we have the Sri Lanka Accounting and Auditing Standards, which is at number 15 of 1995. And then we also have the Securities and Exchange Commission of Sri Lanka Act number 36 of 1987. So these are most important statutes that governs preparation, presentation, and publication of financial statements. Okay. So what is the responsibility as far as the banks are concerned? The preparation and presentation of financial statements, they say it is the responsibility of the board of directors. Because as I mentioned to you all some time back, the board of directors are the agents of whom? The shareholders. The shareholders are the principal and the board of directors are the agents. So there is a relationship between the principal and agent. But what is the responsibility of the agent? The agent has to prepare, present, and publish the financial statements for the shareholder to go through. That is an important aspect when it comes to preparation of presentation of financial statements. So the board of directors is responsible for the preparation and presentation of financial statements of licensed commercial banks. In this regard, the board of directors is required to ensure the following. What are the following? Maintaining of proper accounting records. So banks have to prepare, maintain proper records of their accounting transactions. Implementation of adequate internal controls for safeguarding the assets of the bank. Now, if you go and look at your respective banks, there is an important function played by all the directors and the management where they have to look after the internal controls of the banks. Why you need internal controls? Because to safeguard the assets of the bank. And more importantly, their responsibility is to minimize the risk of frauds and irregularities. So you might have heard so many things happening, but the prime responsibility of the board of directors is to minimize the risks of frauds and irregularities that might happen or that could happen. Okay. So apart from preparing presentation and publication of financial statements, the board of directors hold the responsibility for these three important elements. What is that? Maintaining proper records, implementation of adequate internal controls, and minimizing the risk of frauds and irregularities. The Sri Lanka Accounting and Auditing Standards Act number 15 of 1995 apply mainly to the preparation, presentation, and audit of the financial statements. Okay, so this was effective from 1st of January 1999. The Act defined certain enterprises to be specified business enterprises and made it to be compulsory for SBEs to prepare financial statements in compliance with the Sri Lanka accounting standards, take all necessary measures to ensure that the financial statements are audited in accordance with the auditing standards, where they have to ensure true and fair view. Please underline the term true and fair view, because preparing financial statements is a task, but doing that task to ensure something is very difficult. So your financial statements should reflect a true and fair view of the financial performance and the financial positions of your company. That is your profitability and your balance sheet. The assets that you are showing has to be somewhat accurate. The profitability that you are showing has to be somewhat accurate. So it is very important that you prepare your financial statements which reflects a true and fair view of your company's financial performance and financial position. And you also have to have the financial statements audited by members of the Institute of Chartered Accountants of Sri Lanka. So now we come to an important point where who is going to audit our financial statements? Now, the financial statements are audited by member firms. We call them as member firms of CA Sri Lanka. Member firms of CA Sri Lanka. So I can name few, namely say you can have Ernst & Young. We call them as EY, the auditors. Then we have KPMG. We have PricewaterhouseCoopers, BRD Silva. Likewise, you have so much of audit firms. These audit firms are members of the CA Sri Lanka. So all governing rules, principles, and the standards that they need to maintain are entrusted with these member firms. So when we prepare our financial statements, we go and get the services of these member firms to audit the financial statements. We don't go to the CA Sri Lanka to get it audited. It doesn't apply. So we go to these member firms for their services to get the financial statements audited. And once the financial statements are audited, the audited financial statements of the it has to be SBE to the Sri Lanka Accounting and Audited Standing Board, Monitoring Board, to enable the /MB to determine whether the financial statements have been prepared in compliance with Sri Lanka Accounting Standards. So this is another duty of the organization to ensure that once your financial statements are audited, you have to submit an annual audited financial statement to an organization called /MB. We call that as /MB. What do you mean by /MB is Sri Lanka Accounting and Auditing Standards Monitoring Board. Furnish to the /MB or to any person authorized in that behalf any information pertaining to the SB's financial statements. Now we come to the requirements specified in the Banking Act with regard to the preparation, presentation, and publication of financial statements. So we were looking at annual audited financial statements. So licensed banks are required to prepare, present, and publish in accordance with the forms specified by the above act. So now you don't have to worry about what is this format and all about. What you need to know is what is the section that talks about where the licensed banks are required to prepare, present, and publish audited financial statement, annual audited financial statement. So it can work in two ways. Either they can say what is there under section 38(3) of the Banking Act, or they can ask you what is the section that is applicable and which is talks about annual audited financial statement. So you can be tested on both ways. Either the section can be given and you will be asked a question, or you will be given some details and they will be asking you the section. Then similarly, section 38(1), 38(2), and 76(h), which talks about that your annual audited financial statements have to be published in Sinhala, Tamil, and English newspapers. Okay, there had been several MCQ questions on this, so you have to be very clear with that. what is the section that talks about this, or what is there in the sections mentioned above. Then also it talks about exhibit them in a conspicuous place at each of its places of business until financial statements for the succeeding financial year are prepared and exhibited. Now, this is very important. Now, even when you are in your branches, there is a requirement that in every branch of a particular bank, they have to display their last audited financial statements, where the customers, when they come into the branch, can see it. Okay, that is what they say. Conspicuous place means where you, when the customers enter your branch premises, they should be able to see your audited financial statement. So you can't be showing them a book and saying that this is our annual report. No, that is not the requirement. The requirement is where you have to exhibit them in all of your branch premises. Every branch where customers have access, your annual audited financial statements have to be displayed. Okay. Then 38.1 again, 38.2 and 76H also talks about licensed banks are required to transmit it audited financial statements within 5 months after the close of its financial year. Now, this is again very important. Now, we know that you need to publish your financial statements, but when? This is from the year-end closure within 5 months. Say, for example, if your financial year is ending at 31st December, then the next year, before 31st May, you have to publish your financial statements. You see, that is how it is given. This is the annual audited financial statement. Please remember that, annual audited financial statement. Okay, and what they talk about is in respect of its business in and outside Sri Lanka, including its offshore banking business. Okay, so we were talking about FCBUs. This is what it is. Then they also say the same sections, quarterly financial statements. So we were talking about interim financial statements. Now your annual audited financial statements will be 31st December, but your quarterly financial statements will be 31st March, 30th June, 30th September. Likewise, you have to. So when are you going to publish that? Publish unaudited quarterly financial statements within 2 months from the end of the quarter in Sinhala, Tamil and English newspapers. Now, this is again a question. So you need to understand what it is. So now let's assume that you are a 31st December bank. 31st December bank. Now if you are a 31st December bank, this is the first requirement that comes where you have to publish or provide your audited financial statements before 31st May 2020. That is the prior requirement. Okay. But subsequent to that, you also have the requirement to publish financial statement on a quarterly basis. So the quarterly basis means 31st March 2020, 30th June 2020, 30th September 2020, and then you go to 31st December. Now, before getting into 31st December, there is a requirement of these three. That is what we are talking about, quarterly financial statement. So, when is this? Within 2 months. 2 months means you are given date or time till 31st May 2020. This is 31st August 2020. This is 30th November 2020. So this is how it works. This is how it works. So within 2 months means you have to consider each quarter how it works. Now, if you are a 31st March completing bank, then these dates will differ. This will be your annual, this will be your quarter 1, quarter 2, quarter 3. Okay. So in exams, this could be tested. You have to be very careful how to answer the question according to the requirement of the question. So don't go get messed up with what they are asking. Here they say publish unaudited quarterly financial statements within 2 months from the end of the quarter. Within 2 months from the end of the quarter. That is what the dates I showed you. Then Section 39 and 76H, appointment of an auditor. Now, who is an auditor? I told you about the member firms like EY, KPMG, Pricewaterhouse, BR De Silva. There are so many auditors. So licensed banks are required to appoint annually a qualified auditor from an out of the list issued by the Director of Bank Supervision. Now, who is Director of Bank Supervision? He is a member of the Central Bank of Sri Lanka. Because the Department of Bank Supervision is the department which governs all the licensed commercial banks. So the licensed commercial banks are monitored and governed by this Bank Supervision Department. So this Bank Supervision Department, they publish a list of all the auditors who can be considered by the banks. And they also say the audit report should be completed within 3 months of the end of the financial year. So which means, now earlier we were talking about when to publish the financial statements and so on. But your audit has to be completed within 3 months from the end of your financial year. So if you are a 31st December bank, then by 31st March, you have to complete it. If you are a 31st March bank, then by 30th June, you have to complete this activity. Then we get on to a topic called corporate governance. Corporate governance is something which I already mentioned. The way in which your bank or the company is controlled and directed. So your board of directors, your corporate management, they are the people who are governing your company or the bank. This we call it as stewardship. I mentioned earlier also, what do you mean by stewardship is this corporate governance. So corporate governance is the system of rules, practices and processes by which a company is directed and controlled. Now, if you look at your respective banks, you will be having so much of policies. You might have circulars, directions, instructions. So many things are there within your bank. So why all these are there? That is to better control and direct your company or the bank. Corporate governance essentially involves balancing the interest of a company's many stakeholders, such as shareholders, management, customers, suppliers. So we have already discussed all this. Who are the stakeholders? There could be several stakeholders. What is the importance of corporate governance is to ensure that there is an equity treatment for all these stakeholders. Okay. So corporate governance also provides the framework for attaining a company's objectives. It encompasses practically every sphere of management from action plans and internal controls to performance measurement and corporate disclosure. So they are talking about many things. Your internal control practices, how you publish your financial statements, what are the disclosures that you are giving. So it develops a framework. Now, the best thing to know about this is you go through annual reports of the banks, where they will have a separate section called corporate governance or governance structure or whatever, something related to that name, or stewardship. By that name, there will be so much of information that you can read and understand. Then according to the Banking Act Direction number 11 of 2007, the corporate governance measurements. The following rules and responsibilities shall apply in relation to the audit committee. Now we are talking about something very important. Every company should have an audit committee, which will be headed by a person who is on the director board, and there will be representatives of the other directors. So the chairman of the committee shall be an independent non-executive director who possesses qualification and experience in accountancy or audit. So when you take your board of directors, there will be people who are qualified and who have done accountancy qualifications, who are possessing accounting qualification. So one of those members will be your chairman of the audit committee. Chairman of the audit committee. And there are few things, all these are reading material. I'm not going to go in detail, but whatever that is mentioned here is all relevant with regard to the audit of a company. So they talk about the appointment of an external auditor for audit services, the implementation of the central bank guidelines, the application of the relevant accounting standards, right? All those are very important. In addition to that, this audit committee will also decide what is the fee that should be paid to these external auditors, and when they are supposed to be appointed and when they are dismissed. All those comes under the purview of the board audit committee. There has to be a specific reference to the section G, because they say the committee shall review the financial information of the bank in order to monitor the integrity of the financial statements of the bank, its annual report, accounts, and blah, blah. So what they say is, when you are a bank and preparing financial statements, your financial statements have to be first presented to the audit committee. The board audit committee will go through your financial statements, and then they will give you a confirmation on the financial statement that it is in order. Once you receive that confirmation only, it goes to your board of directors, because the board audit committee will be a small component of your board of directors. Then it has to go to the full board of directors. With their recommendation and approval, then only these financial statements go into the public. This publication in the newspapers, putting it in the website, or giving it in any other medium of annual report or CDs, whatever it is, all these can happen when beforehand you have done with the board audit committee. They have to give you the recommendation and approval for you to go ahead and publish the financial statement. And this committee also discusses about the problems or the lapses of internal controls that the banks or the companies have. And these lapses and internal controls will be identified by the external auditors, and it will be highlighted at these audit committee meetings. So based on that, the audit committee or the directors who are in the audit committee have to make recommendations and take actions to rectify all those internal issues. Right? So the next few sections are specifically relating to the audit function of the bank. Audit function of the bank. So I'm not going in detail because it is all reading stuff. So I want you all to read these and understand. Okay. We'll come to this appointment of an auditor. Every licensed commercial bank shall appoint annually from an out of the list issued by the Director of Bank Supervision an auditor to the company. Now, how these auditors get appointed is at the annual general meeting of the bank, there will be a proposal by the board of directors to the shareholders that you are nominating a certain auditor. Then the shareholders will have to approve the appointment of that auditor. So what are the duties of an auditor? That is what is coming next. So I'm again leaving that to you for you to read through those items. Right. This is very important. Expression of an audit opinion. Now, I told you that the financial statements have to be audited by an external auditor. Now, when you do an examination, you know a result out of that examination. So that gives you some satisfaction or assurance of what you have learned or whether you are acceptable. Similarly, when a company prepares their financial statements, you need to get some assurance about your financial statements. So the auditor actually, when they do the audit, at the end of the audit, they give you an auditor's report. They give you an auditor's report. In that report, there is an expression of opinion. This opinion is somewhat similar to the results that you get when you do an exam. So the auditors give an opinion about your financial statements, your internal controls, all those information. How does this work? The audit opinion has two forms. We call that as an unqualified opinion and a qualified opinion. These two have to be clearly understood. An opinion is said to be unqualified when the auditor concludes that the financial statements give a true and fair view. Now, don't get confused. When people get through an exam, we say they are qualified. If they don't get through, they are unqualified. But when it comes to audit opinion, when everything is perfect, we say that is an unqualified opinion. If you have problems, then it is a qualified opinion. This difference have to be clearly understood. So let's go through it. An opinion is said to be unqualified when the auditor concludes that the financial statements give a true and fair view. Can you remember what is true and fair view is? In accordance with the financial reporting framework used for the preparation and presentation of the financial statement. So if your financial statements are giving a true and fair view, means there is no problem, everything is perfect, there are no lapses of internal control. So which means anybody looking at your financial statements can depend on that or rely on those financial statements. So when you have prepared such a financial statements, the auditors will give you an opinion of which is called an unqualified opinion. Similarly, you can get a qualified opinion when the auditor encountered one of the two types of situations which do not comply with generally accepted accounting principles. So the auditors may qualify your financial statements considering that it has certain deficiencies. Either you might have not followed the accounting standards properly, or you have some internal control lapses, you are not maintaining proper records of transactions. So there could be so many issues. So as a result, the auditor can qualify your financial statements considering specific factors. That is what we mean as a qualified opinion. Qualified opinion. The auditors can also give an adverse opinion. An adverse opinion report is issued on the financial statement of a company when the financial statements are materially misstated. Please underline materially misstated. What do you mean by materially misstated? Materially misstated means you can't depend or rely on these financial statements. Your asset position is too much, liability positions are not settled in time. So many issues can be there. So when there are those type of issues, the auditor may issue an adverse opinion. Adverse opinion. So adverse opinion means you can't do anything further. Even if it is a bank, actually the central bank might cancel your license even, considering that your financial status is not that great. An adverse opinion is issued when the auditor determines that the financial statements of an auditee are materially misstated and when considered as a whole do not conform with the GAAP. What do you mean by GAAP? Generally accepted accounting principle. So when your financial statements are not even acceptable to the generally accepted accounting principles means you will get an adverse opinion. So that brings us to the end of regulations to banks. So I hope you can read through this material and you have to go through the past paper questions also and see how best you can interpret the questions to pick answers from this. Okay, so what we have captured here is only the most important relevant subject components which are generally tested. But as I told you, this area is very vast. So you need to be very careful in what is happening in the current trend. What are the changes that are taking place? What are the implications that are up to the banks? All those will be in this particular section. Because regulations to bank is a separate question in your exam. There is one separate question for 20 marks. So you have to be very careful in choosing that question because you have to be very thorough with the theoretical part of that area. Specifically, these regulations to banks, you have to know the sections, you have to know the definitions, you have to know the underlying theory behind that. All those are very important. So now we have come a long way in this module. So I want you to understand and complete all your revision work. Don't leave it to the last moment because we are almost towards the end of this course. So what is left for us is to do the financial instruments, which is the next standard that we are going to do, SLFRS 9. And then we have also remaining is the statement of cash flows, which is LKS 7. So those are the two important areas that we need to cover up. So we might be able to finish off that within this month and then complete the entire syllabus of this module. Okay. So I want you to read all these and do the revision work. And once you complete, if you have any questions, please do post. Okay. So we'll stop there. Have a pleasant weekend and see you all.